Hey everyone, welcome back to the channel. Today we're breaking down a very interesting mid-cap stock from the paints sector, Indigo Paints. It's trading near its 52-week lows, and investors are asking, is this a buying opportunity or just a value trap? Let's decode the fundamentals, valuations, and entry strategy to find out if Indigo Paints deserves a spot on your watch list. Indigo Paints is one of India's youngest and most creative paint brands. It's known for its catchy marketing campaigns, innovative product line, and bold color themes that make it stand out even among giants like Asian Paints and Berger. The company has built a strong presence across smaller towns and cities, focusing on the growing home improvement and housing demand outside metros. They've been consistently launching new products and expanding their dealer network across India, which is a big driver for their long-term growth. Let's talk about the numbers. For FY26, so far, revenue has been fairly stable compared to last year, showing that the top line is holding up despite some industry challenges. However, profit after tax has seen a minor decline because of continued margin pressure, mostly due to raw material costs linked to crude oil derivatives. Still, the company's EBITDA margin remains in the 14 to 15% range, showing operational resilience. And what's more impressive? Indigo Paints remains completely debt-free, maintaining a healthy ROCE of around 17%. That kind of capital efficiency is rare for a company still in its high-growth phase. Now, let's move to valuations. The stock trades at a price-to-earnings ratio of around 35 times, which is definitely on the premium side, but that's not unusual for quality paint companies in India. Its EV to EBITDA multiple is broadly in line with peers, meaning the market continues to price Indigo as a strong growth story. Based on current earnings, the intrinsic value range works out between $1,200 and $1,300 per share. That gives an upside potential of around 15 to 20% if margins improve and sentiment turns positive in the broader paint sector. On the positive side, Indigo Paints is a premium young brand with great recall. They innovate quickly, especially in niche and premium products. The dealer network is expanding fast, especially in underpenetrated regions. And with zero debt and high returns on capital, it's built on a very strong financial foundation. But every story has a few risks. First, raw material prices. Since many inputs are crude-based, any spike there can hurt margins. Second, a slowdown in housing or infrastructure demand could affect growth. And lastly, valuations are not cheap, so any earnings disappointment can cap short-term upside. So how should you approach it? If you're a short-term trader, look for entries between 980 and 1,030. Your targets could be around 1,100 to 1,200, and a stop-loss below 950. If you're a long-term investor, this is more interesting. Consider accumulating between 900 and 1,000 and holding for a 1 to 3 year horizon. If the margin recovery and premiumization cycle plays out, you could see targets between 1,400 and 1,700. So to wrap up, Indigo Paints isn't a deep value stock, but it's a quality compounder. It offers a strong brand, expanding network, clean balance sheet, and consistent growth potential. At current levels near its 52-week low, it's a good candidate for staggered accumulation. Ideal for patient, growth-oriented investors. My verdict, reasonably valued with 15 to 20% upside potential. It's a premium paints play, not flashy, but built to compound steadily over time.